Welcome to the daily update, where I'll go over the action in the market for Monday, November 17th, and we'll see how things look for Tuesday, November 18th. All right, well, yeah, we're shifting more negative now. We started to see that after Friday. But on Friday, the 50-period moving averages, not just for the S&P, but across a number of indexes and different areas that are very influential in the market, all of those levels held. Well, we lost them on Monday, and so that's shifting things more negative. We're still seeing a market that's getting more defensive. Growth actually held up okay on a comparative basis. It wasn't a real bloodbath in that regard. And then there's the big event that's going to be coming out after Wednesday when the market closes. That's Nvidia's earnings. Now, is that going to bump us up here? The scenario that I was just kind of throwing out there over the weekend is that, all right, the 50-period moving averages have held. And when that happened in 2025 so far, we were able to come up out of that. And so the futures were actually pretty strong. We were up over 0.5% when they opened Sunday evening. And then once Europe opened, they started to drift a little lower. And then as we got close to the open, they were down to pretty much unchanged and then going slightly negative. That helped to produce a lower open. The buy the dippers tried to come in right off the bat, took prices actually positive a little bit, but then things in the afternoon started to see more conviction to the downside. And that's what we're seeing, more negative conviction in the short term. We're turning negative now in the intermediate term because we're below the 50-period moving average. So, yeah, things are this whole positive seasonality that's market's going to magically go up. It's gone up before since we came out of the lows last spring. That seems to be in question right now. But at the same time, the bigger picture is still looking okay for right now. We can still take more of a hit than what we're seeing right now and still have the bigger picture remain positive. So I'll go through and show you that with the charts. Now, before I get into the rest of the video, from now until the end of 2025, I have a thing called the SPX investing program. I developed it, I run it. It's run through Substack. Now, if you sign up, that's free. You don't have to do anything, just an email address for that. But if you want to have access, there's two different parts. There's one part where you have to provide payment information, even though nothing is charged to you. It's free. All right. And then you can get a chance to see some of the extra things that I post there. Also, the videos are available right as I create them, where they're held off with YouTube and Rumble. And there's some additional things also that you might find interesting. Now, if you don't want to provide any payment information, there's another website, kind of a sub website of this, where you can sign up and still get immediate access to the daily and weekly videos and some additional information. But there's some that I don't give there, like trade ideas and actual strategies that I'm implementing. And I do a video about that. Well, I don't do that in the free part of the website. I only do that in the free part that requires payment information. So I know it's kind of confusing. I wouldn't have set it up this way. I kind of had to do it because that's the way Substack wants it. So, all right, check that out. See if it's something that will help you. And any of you that are new, welcome. I had a number of people signing up recently. And another thing that you can do is I like to talk to people. I'm an educator, and I've been an educator my whole life. And you want to set up a time on Zoom or Messenger or something, and we can get to know each other a little bit and just see if working together is a good thing. Let's do it. So send me an email if that is something that you would like to do, or leave a comment on the website, or even on YouTube or Rumble. That would be fine too. Okay, so let's go back and talk about what happened. We did have a lower open after we were looking kind of positive. There's a video that I prepare anywhere from 8 to 10 hours, sometimes 4 to 6 hours before the market opens. It's where I'm actually developing my strategy for that particular day. And at the time I prepared that video, we were looking pretty strong. And I've been doing a lot of market neutral type positions lately. Not now. Now we're starting to switch over and see a trend develop. But it looked like, okay, maybe we'll get a bounce out of this. And that actually would have helped some of the market neutral positions that I've been doing lately. Well, then we had a positive start and those positions were holding up okay, but then when we broke lower, it's like, okay, these strategies aren't working as good as before. It didn't take any losses, but kind of got out at break even on some of those. But we ended up having a lower open at the daily pivot, 67.18. Then we attempted to go positive and we got above the unchanged level, and that set the intraday high right around the 67.50 level. That was it. That was as high as we were going to go in Monday's session. Then we chopped between 6,700 to the downside and 6,750 to the upside and looked like, okay, we're just going to be in a range. Well, then we go into the afternoon session. And if you watch the market day after day, there's the open and then there's the morning part that lasts up until about lunchtime. And then in the afternoon, sometimes the market can completely switch its character. And that's kind of what happened in Monday's session. So then, as we got to the afternoon, prices declined below 6,700 and S1. So now we were breaking lower here at 66.63. We did find support slightly below the 66.50 level, and then we bounced a little bit up into the close. There were some kind of positive comments that came out right about when the market closed that they're being attributed to seeing a little bit of a bounce. I think it was more of a technical thing where you had folks that are short in the market. They were starting to see some profits and they sell to get in, they have to buy to get out. And when a number of people are doing that at the same time, that pushes prices back up a little bit there. But we closed a little bit back above S1. We were down 0.92% on this is encouraging, below average volume. Some of the big declines, last Thursday was an exception, and that was more of take money out of the market. We weren't really seeing rotation at that point. We were just seeing just outright selling, not just going from one area to another area. That was above average with volume. Well, Friday ended up being below average, Monday's below average, and that's somewhat encouraging that we're not seeing an awful lot of conviction, at least to this point. And then we are now negative in the short and intermediate term. We've been negative in the short term since we dropped below the 20 period moving averages. Now we're below the 50, so we're getting negative in the intermediate term. Long term, we're still positive though. And interest rates kind of just not really being a real factor at this point. The market's not worried about inflation, and I pointed that over the weekend. I have a number of different charts where I go through, I have an intermarket analysis video, a deep dive video, a weekly video, and a what to watch video. And I pull a lot of these charts together and say, okay, the news media, blogs, other videos, they can say whatever they want considering inflation. But what is the market saying? And I go through that and I look at charts that tell us this is what the market thinks. We may not know what's going on behind it. We can just see what's happening in the price chart. And the market's not worried about inflation or interest rates at this time. And we watch those charts to see if that changes. And let's see. Not much else really happening. Just kind of, I mean, there's a lot of things happening, but not things that are really having a direct impact on the market. So we did close below the 50 period moving averages, not just for the S&P, but a number of different indexes. I'll show you those charts. And we're still seeing more semiconductor weakness. Now, this is ahead of Nvidia coming in. Is this what we've seen before is the buy the rumor, sell the news, where prices get propped up and then the earnings report comes out and then we see selling. Are we seeing the opposite of that right now? We don't know, but to see weakness and then Nvidia comes out and everybody's happy and it's a great report and that changes the whole context of the market and we start going up again. That could happen. Or they come out and they might have a stellar report, but there's one little bit of that that the market's disappointed with, and Nvidia ends up seeing more weakness. Yeah, that's why it's a big variable. That's why we want to know about this before it happens, that after the close on Wednesday, Nvidia will report their earnings. And okay, the VIX, yeah, that's good. It should be the VIX. Okay, obviously a typo. We're above 20 at 22.38. Haven't been above that now for quite a while. We were above it on Thursday and Friday, but then we ended up closing down below 20 with the VIX. Now we're closing above 20, and this is shifting things more negative, and I have a chart to show you of that. And there was some federal open mouth committee here that came out. Fed Chair Jefferson struck a similarly cautious tone to other. See, we're seeing the same kind of theme coming out of the Fed officials right now, where he said that he backed last month's 25 basis point cut, but emphasized the evolving balance of risks underscores the need to proceed slowly as we approach the neutral rate. The neutral rate. We're trying to get down to 2% with inflation here. And this is the fancy way of saying there may not be a rate cut in December. All right, then Christopher Waller said that he supports another rate cut in December. This was near the end of the close, and he's a little bit more dovish when it comes to Fed policy. And this is being attributed to a little bit of a bounce. And the futures are a little bit positive. I checked right before I started recording, but it's many hours before the market gets set to open. And so he thinks, all right, maybe we'll have another rate cut, and it helps stocks a bit going into the close. We still have this thing called a Hindenburg Omen. Now we don't have a new spike after Friday, but we have a series of spikes, and I'll explain more about that when I get to the chart. And now we're seeing more conviction here in the short term. That's negative. We have the Connors RSI. Doesn't come on this list very often, but we're looking extreme that way, showing extreme negative conviction. And now we're starting to see a buildup of the usual charts that show the conviction of the short term for the market. The Stochk RSI, which has already been here. Now we have a new addition, the Williams Percent R. The CCI 14 was on this before or after Friday. Now we have the CCI 20 joining in, a little bit longer term, and the stochastics, which haven't been showing much conviction. They usually always show some kind of conviction. Well, now they're starting to look a little bit more negative in the short term. And I'll show you charts of all of this. And no change to the scenario. It looks like maybe the rate cut in December is likely not to happen, which at the same time, just think of the markets. If they've been coming out saying no rate cut, no rate cut, doubtful, 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 and then it happens, that could be like what we call the Fed put here, where they're protecting the market, and then the market just skyrockets up out of that because it's a surprise. They weren't expecting it, and it's considered to be good news. Don't know if it's going to play out that way, but we just need to be prepared for all scenarios as things unfold. All right, the dollar was up. That could be pressuring stocks. And I have an interesting chart to show you later with the dollar. And interest rates were down 4.13% with the 10-year yield, where we were at 4.15% after Friday. We're getting really extreme as far as negative sentiment. This could actually be positive for the market. We're not only under 25, we're all the way down to 15, and that's a very low reading. You've got a lot of pessimism that's been coming back into the market now, and when the market gets overly pessimistic, we're like, okay, maybe we look at this as a contrarian indicator. We just take that attitude. We don't actually start setting things up with that in mind. We have to look for confirmation in other charts that we're not seeing yet. But sentiment, and now it's 15, it could go down even more than where it's at right now. And now we are starting to trend, but it's not confirmed. And I'll show you this. We're negative with the short now and intermediate term. The short term and intermediate term are the ADX is starting to go up. They're crossing above their moving averages, but they're still below 20. That's why they're not confirmed. But they are negative with the red line above the green line, and with the down day, the bias is negative. Usually the bias, I pick this out. I might go with just one day, sometimes bleed over into a couple of days. That's just what's the general feeling overall. Where the momentum is the last number of days taken together. That's also negative right now, and we are short-term trading. Okay, well, what's with the typos here? It should be short-term trending right here. All right, yeah, it's Monday for me too, folks. Sorry about that. Okay, so we did get a few economic reports, not major ones, and I'm still not really sure what's going to be released, when it's going to be released. We just kind of have to take it as it comes here. This is more regional with the New York Empire State Manufacturing came in at 18.7. They expected at 6.8. So that was stronger than expected and up from the 10.7 that we saw last time. Total construction spending it came in stronger than expected, up 0.2% month over month. That's fairly good for the economy. They thought it was going to be up 0.1%. Last time it was up 0.2%. And then they break it out here. Total private construction up 0.3% month over month, and public construction was flat month over month. Okay, and then year over year, it's still down 1.6% though when you annualize this. So here is a chart of this. I haven't been able to show many economic charts lately. This is the New York Empire State Manufacturing Index, which is showing some optimism there. And for the New York region, that could end up being more positive. And then construction spending, this is the year over year, still below zero. Even though it's flattening out a little bit, it's still declining on a year over year basis. Then we look at the year over year, the residential, it's going up where the non-residential is starting to go down. And then month over month, where not much of a change from the previous reading, but still positive. Okay, then we have a bunch of charts here. Midterm fears tend to bottom later in the year and see larger corrections. All right, this just kind of takes us through the reality, which we really haven't been dealing with in since we came up out of the lows in April. It's like we just see these little declines, and then the buy the dippers come in, and we start going back up. Where we taking April out of the equation, which we shouldn't do, but this is more for context. Even when we have good years, we still can have pretty significant downward moves within that. And this goes all the way back to 1950. It talks about the average decline here, 17.5%. The median is 16.6. And then a year later, we tend to be fairly positive. So again, just everybody thinks that the way the market is right now is the way it's always going to be. And no, it changes, it ebbs, it flows, it goes through positive times, negative times. It has times when all of the news is taken as good and then all the news is taken as bad. And we're just kind of going through one of those shifting times right now, different than what we've been seeing for most of 2025. And we're coming down a little bit here with the stock positioning overall, but we're still above zero. But there has been some selling coming in here. And then this is another way. Again, I don't do things this way. This is a NASDAQ 100 outperformance. It's coming down a little bit here, but now this is before Monday's session. And the reason I don't do it this way is it seems like they're kind of liberal with the trend lines here. It's like we're trying to make up a certain conclusion, and now let's draw the lines to make that conclusion happen. But this just shows how the NASDAQ 100 has actually been outperforming the S&P 500, which is good. And that's when the market is more positive. And we're seeing that shows a little bit of weakness currently. All right, discretionary to systematic. We get these charts a lot where basically the dark blue, this is a systematic where you just follow a system. You don't necessarily pay attention to what's going on in the market, which tends to do better when the market is holding up. Well, now it's been under a little bit of pressure since those folks are seeing some losses. And then the discretionary, where you try to maybe time the market, it tends to underperform when the market is in a strong uptrend, but it tends to hold up better when the market's starting to go down. But that's even coming down a little bit in this latest chart as well. And then here, the modest sell-off in the S&P, well, tell that to Monday, took it to the bottom of the steep trend channel that's been in place. So we're just kind of down around here right now. We haven't really broken out. This is more like the chart that I use, except I like to connect hot tops with tops here. And so we're still holding up okay for right now, but we'll watch this on a day-by-day basis and see if things start to turn a little bit more negative. All right, now when we see this chart, this is probably the fifth or sixth time we've had this, but they have adjusted it. Goldman Sachs actually raised their estimate up to 7,600 for the S&P, and they're still raising their earnings going forward here. So this is a little bit different than the chart that we saw for many times. All right, then we switch over to a different source here, the fiscal impulse. Tariffs were a fiscal tightening worth 1% of GDP. Okay, you kind of got to figure it out in this statement here. The big beautiful bill was an easing worth 1% of GDP. So they cancel each other out. But the tariffs happen in 2025, where the tax cuts arrive in 2026. The fiscal impulse will swing from minus 1% GDP to plus 1 or 2 points. Okay, that's according to Dario Perkins here, who thinks that this whole thing that's been happening with the big beautiful bill and the tariffs and all that stuff, that it's eventually going to be okay. So we'll have to see how it works out. There's been a lot of people that have been wrong about this. I don't know if this person's right or wrong or not, but a lot of people came to conclusions that they thought were pretty much the way it was going to be. And to this point, they've kind of missed the mark on that one. All right, hedge fund trading flow. While U.S. equities were net bought on the week, people were buying them, and we have a lot of individual investors. So our PB team, what peanut butter and jelly team, noted a continued rotation into defensive sectors, and that's what I've been pointing out in the videos. We're still looking okay in the bigger picture with growth outperforming value, but shorter term, going back to August, we've been seeing a gradual shift, and sometimes this shift picks up steam, and it picked up more steam last week, going from growth areas to defensive areas. And so that's basically what's been happening. It's kind of borne out here in this chart. In with short sells, people going short on the market, long outpacing long buys, and then and long buys outpacing shorts in healthcare and staples. Those healthcare been doing really well lately, and staples holding up fairly well. These are more defensive areas, and that's what some folks have been getting into lately, and that's a more defensive move on the market. All right, and then the S&P 500 and the 50-day moving average, it finally closed below it. Yeah, after 138 days. Here's what it did after that. And if you want to break this all down, go for it. You can just pause this and look. But the further out we go, usually about a month later, we tend to bounce up from that. And then maybe 3 months later, we're up there. But it's not all doom and gloom. And that's why we're maintaining our view of the longer term to see if that's changing. And to this point, and I'll prove it with the charts that I'm going to show you, that we just watch this day after day. It's not really changing in the bigger picture, at least yet. But we are looking at some shorter to now even intermediate term weakness that's been coming into the market. All right, and then sector returns, where we still see tech doing about the best. Earnings per share looking pretty good, and the PE not really rising all that much. It's still overvalued though. And this just breaks down the different areas. Communication, these are the two big growth areas, and so we want them to do well. We want their earnings to grow if we're more positive on the market, and we want their PE to stay somewhat under control here. And these are actually outperforming the S&P 500 itself. And utilities have been coming on. Now, again, utilities are typically seen as a defensive area, and that's kind of what they played a role in on Monday because they were up. But you could also put it into the growth category because we have AI that just needs massive amounts of power. You have electric vehicles, you have all this crypto mining that's going on. There's just a really big need for electricity. And so you could somewhat justify saying, oh, utilities, they used to be defensive. I mean, it was widows and orphans. You bought these stocks and you gave them to people because they were very dependable. They usually pay well in dividends. Now it's kind of turned into more of a growth area. And then the industrials, which have been under a bit of pressure lately, they tend to follow more with what's going on with the economy. And then the other areas that have been underperforming the S&P with real estate down here at the bottom and staples, that's a more defensive area. Discretionary, we would like that one to be doing better. And it's actually been declining as far as its PE ratio. Okay, then earnings growth, Russell 2000. Yeah, we see this chart a lot. And going out into the future, small caps, well, they're all going to be large caps by then. It's just what's the reality going to be? You can project into the future. This is 2026, what their earnings are going to be. We saw the same thing. 2023, 2024 is going to be it for small caps. Then 2024, 2025 is going to be it for small caps. And then they have to end up coming back down here. So, okay, yeah, it's nice to be optimistic about what will happen, but then at some point you have to be realistic about what's actually going on. All right, so here, intraday chart. Didn't look like we're going to have all that crazy of a day. We opened a little bit lower and then just kind of chopped sideways. We broke down a little bit and then it looked like, okay, maybe this was the low for the day and we're going to be able to go up from here. Nope, we actually went positive, stayed there for a little bit, and then we hit the afternoon. We broke down back below the daily pivot and then what had been previous support in the morning at the 6,700 level. Now we broke down below that, and that's when things started to get a little bit more tense. We came down below S1, actually broke below that. We dealt with the 6,650 level, and then this a little bit of bounce going into the close, which they're attributing to some positive Fed comments coming out that maybe there'll be a rate cut. Okay, all right. I tend to just look at the chart itself and see this more as a normal market reaction here. So yeah, it was a pretty negative day in that regard, and we're not changing all that much in the initial overnight reaction. We did come down a little bit right as the market was closing here, but things were actually positive. You can go over here. This is Sunday evening when the futures opened. We were up. And then we just kind of drifted down. Europe opened. We got closer to the US Open and we gyrated around and then saw most of the weakness come later in the day on Monday. And we're still seeing a little bit more weakness here. Now, the red line is still above the blue line. That means the market's a bit more defensive. But even more important than that is we look at the direction of these lines, and they've been going down. But they haven't really broken out of this range yet. And if you take the bigger picture, you go back to the end of May, where these have been going up and to the right for the most part, and they're not really falling off a cliff at least yet. Now they're showing weakness for sure, but they're not really changing their overall character, at least at this point. All right, this is a little bit more negative, but we did see a nice little bounce coming here with the S&P growth to value intraday chart. So it's still negative overall, still dealing with the lower end of these moving averages here, but we did get back above a couple of them. But you can see we've been coming down and we fell below this range that we had been in there for a while. And then the end of day chart where growth was down less than value. So growth got hit, but it got hit less than value did. And it was down less for the mid caps, even though it got hit pretty hard, and also less for the small caps. But what I do is I look at the right hand column, that's growth, the left hand column is value, and then these are the corresponding ETFs. Like this is SPY here in the middle. And that just gives us an idea of what's going on. And I watch this pretty heavily. It updates in real time on the software that I have. And then this is a screenshot at the end of the day. And so we bounced a little bit up here with the small cap growth to value ratio end of day chart, but you can see we've been coming down now with the small caps. We're still below the 200-day moving average with mid cap growth to value, and that also took a hit as well. And this is the one that's a little bit more concerning. Bigger picture, we're in an uptrend. Now, the longer we stay down here, the more that uptrend might come into question. We actually had a golden cross here. The way the chart lines up, this is where we crossed the 200-day moving average here. But we topped out in August, we came down and we had not been able to get above the 50-day moving average, and now we're falling below the 200. This is showing the S&P getting more defensive. But this actually went up a little bit. This growth to value ratio, now we're still in the rainbow, but it ticked up just a little bit. So growth held up a little bit better according to this measure here. And we're still below the 50-day moving average and declining with discretionary to staples. We want this to be going up in a more positive environment. Now it's continuing to go down. And large cap growth. Now, on over the weekend, I was saying I came up with all these charts and said we held at the 50-day moving average. Now I'm going to show you those same charts how we lost the 50-day moving average, and that's what happened here. We're underneath the blue line, which is the large cap growth ETF, and we haven't done that. You can see we haven't been below this on a closing basis since we broke down last March when things really started to go more negative here. So this is a little bit more significant now than what we've been seeing up to this point. And then as far as the trend, now this is the short term, and we are above the moving average and going up. So we're seeing a strengthening trend. It won't be confirmed until we cross above 20, but we're negative because the red line, even though it came down a little bit here, it's well above the green line. So that is a short-term negative trend. And we're also crossing above the moving average in the intermediate term. Also, the red line is above the green line, but we're still below 20. Now we're in a negative intermediate term trend. And then here is volume, where we were below average with volume. See the one green area that was last Thursday's kind of more hefty decline. Then sentiment, this is a weekly gauge, and this is kind of the tale of two emotions here. In the bigger picture, sentiment is still doing okay. We're at 70.37. It's on a daily basis, we're getting really scared about things. This is a composite of a bunch of different things taken together. And we only see this once a week. And then the other ones that I look at, they update multiple times throughout the day. This is also the Goldman Sachs sentiment indicator, looking a little bit more negative below zero. That's when you have the parentheses here, or yeah, parentheses. All right, and then this is a little bit late. I usually go over this in Friday's video and then usually address it again over the weekend. These are individual investors. When the red line's above the white line, that means they're more bearish, and that's what we're seeing. And this is the actual chart that I show. I can reproduce that, and we're below zero, where individual investors are a little bit more pessimistic. And then we look at the 3 month, or excuse me, 8 week moving average here, where they're kind of getting a little bit closer here, where they were actually seeing more bears than bulls here, and they're actually trying to get to a little bit more bullish stance here. Okay, then every week we also look at this. These are legal insider transactions like CEOs. Now, there was a chart that I did over the last video or two that talked about how insiders, corporate officers, they're just doing massive amounts of selling. We're not really seeing that here. They're not really doing all that much. So we're seeing a bit of contradiction in this. And then here is an insider buying ETF, which has been under pressure quite a bit lately, just like everything else. All right, and then we are now negative as far as the gamma exposure. This is kind of more in the sentiment line of things, where we're 66.72 right now. We broke down below 6,700. We do have some other support here at the 66.50 level. We look down here where the puts line up with the blue line. So, and that's kind of about where we held in Monday's session. We were able to bounce up from that. So that is the support level that's holding for right now. But the bigger picture of this is everything is red. We're not seeing anything green on this chart. The whole area that you see is turning more of a pinkish red. That's negative. And we're still increasing here. We've been seeing this now for a few days with the Ulcer Index above its moving average. That's fear coming back into the market. And we're above 20 now with the VIX on a closing basis. Where Thursday and Friday last week, we traded above it, closed below it. Well, we closed above it in Monday's session. A little bit more negative there because now there's a gentleman named Tom Bally, and he works with earningsbeats.com and stockcharts.com. And he, a while back, did some research and said, okay, what are the annualized returns depending on where the VIX is at? And I haven't had to show this in quite a while because we've been below 20. Well, the further we get below 20, the higher the annualized returns are, the lower the fear is in the market. And then the closer we get to that 20 level, there's still positive returns. They're just quite less than what we were seeing before. Now, when we go above 20, that's when the annualized returns turn negative, and we're up in that 20 range now. So this is shifting things a little bit more negative. So I don't take credit for this chart. I didn't want to crunch all these numbers and do all of that, but apparently Mr. Bally likes to do that. Okay, and then we are still seeing a pickup of the volatility of the VIX itself, both with the bar chart and even on a closing basis. This is really picking up. So the VIX is starting to get more active in and of itself. And we actually were down a little bit with this fear gauge, which is surprising. Usually on a down day like we saw, we would see this going up, meaning an increase in fear, like we're seeing in this other chart. This one increased as well. And then we saw a big pickup here with the daily equity put call ratio chart and a big move up with the 5-day chart, which we've been seeing. And this going up is more negative. That means there's more hedging going on. And this is over a 5-day period of time. And we're going up with the 10-day period of time as well, after we had had a really low reading here. And this is also longer term negative. And now another thing is we're looking at the risk on to risk off ratio. Now, bigger picture, we're okay. We're still going up, but we're seeing a pullback right now, but it hasn't generally shifted over to a more negative stance, at least yet. And we're seeing how large caps are outperforming small caps. Now, small caps really wanted that rate cut in December, which may still happen. They haven't come out and said no. They just haven't come out and said it's a done deal like the market was thinking. And so now the market's pushing it out into 2026. And so in the meantime, even though large caps have been under pressure, small caps have been under even more pressure. And that's when we see this ratio going up, that large caps are holding up better than small caps. And then the high beta to low beta, again, bigger context, we're still going up. That's positive for the market, but we are seeing some weakness here. And then value to tech, where in the bigger picture, value's been underperforming tech, but it is starting to bounce back up and come into the rainbow. We'll be watching this, but right now, this just looks like a normal bounce at this point. And then we've been seeing a drop off here in the momentum stocks when we do a ratio with the S&P. We were range bound for quite a while. Now this is dropping down, and this is also more negative for the market. This is another thing too, and I point this out from time to time. The S&P to staples ratio. Staples are toilet paper and toothpaste. That's defensive. And when the market really starts to favor those, like at the end of 2021, we were seeing this, and then the S&P hit its all-time high, and then we went in to the bear market of 2022. And then earlier in 2025, we were seeing a real shift as the market was freaking out. Well, we're coming back here with this overall ratio, but we're not really changing the overall character, at least yet. And I watch this every day, and this is updated, and we'll see if there's a bigger shift. But right now, the bigger picture is still looking all right. And we're not really seeing much of an increase here with volatility risk premium. Now, other fear gauges that we follow, they're really going up. This one's just at the high end of its range. And then the advanced decline line taking a bit of a hit here. We're coming down based on price and volume, but we're still above these longer term moving averages. And in the short term and intermediate term, we're starting to turn more negative with the advanced decline ratio. Both the blue line and the red line are below zero. And we're dropping below zero with the advanced decline oscillator. This is a 10-day period of time where it's shifting more negative. And we're taking a bit of a hit here, but we're not seeing that reflected in the 5-day or 10-day charts yet with the new highs, new lows. This is the internals of the market. We're seeing a drop off in the new highs, a bit of an expansion in the new lows. And again, if that continues, then both of these moving averages will begin to roll over, but they haven't done that yet. And we are negative with our three smart money indicators. We're right about on the moving average with accumulation distribution. So we haven't officially gone negative in the bigger picture, but in the shorter term with the boom indicator, we are going down below the moving average. And we're going down with the Chaikin money flow. We're just barely positive with the histogram here. That's smart money indicator number two. And we're declining here with smart money indicator number three, the Chaikin oscillator. And we're negative with the vortex. It switched to negative last Thursday and it's continuing to be negative now. Not much of a change here with the cumulative advanced decline line for the S&P based on price. Yeah, we're seeing some weakness, but still kind of chopping along sideways, both based on price and volume. And we're just coming off of setting a recent all-time high with this chart based on volume. Now we're seeing a little bit more weakness here with the advanced decline line studies below the moving average with the NYC common stock. We were a little bit above the moving average on Friday. Now we're dropping below it with the S&P, where we continue to see more weakness with the mid caps and small caps. And then the NYC common stock advanced decline line, a little bit of weakness here, but just kind of more range bound. Also seeing some weakness, but not really breaking to the downside based on volume. And then we look at those stocks in the S&P above their 20-period moving average, below 50 and declining. And I've been also trying to point out is as we were going up here, we were seeing a series of lower highs along the way. And so far that seems to still be fulfilling in what we're seeing as a bigger picture negative. This could mean that there's more room to the downside that still has left to happen. But we never know that for sure. We're also seeing a series of lower highs here with the 50-period moving average, and we're below 50 and declining. That's negative. We're below 50 and declining, also dropping off a little bit here with the 100-period moving average study. And we are declining, but we're still above 50 with the 200-period moving average study. Then short term, now we're below the 50-day moving average. Okay, and now we're a little bit above this dashed line, which is a pivot point. We'll be seeing if that ends up providing some kind of support. And so we're just kind of keeping an eye on that. It's around the 65-75 level here. Now that's for December. Okay, I'll have to kind of micro look at this and see, but this could be a potential support level right now. And we were below average with volume. So we're seeing a bit of a drop off, not surprising here with the 20, 50, and 200 moving averages on the S&P. Now we look at the short-term conviction, and we are starting to see that building up, and it's more negative with the Stoke RSI, the Williams percent R, CCI 14, CCI 20. All these are getting extreme now. We're negative with the Force Index below the midpoint. That's not positive here. And with the short-term stochastic, we're starting to get extreme negative. We're declining below the midpoint with the intermediate short term, and we're rolling over, but still above the midpoint with the long short term stochastic. And we're negative here. This is the bow tie 10, 20, and 30 period moving averages. We still are below that, and we're starting to see the lines roll over as well. And then the condition of the short-term trend based on 20 periods going down here. The green line and the blue line, prices below both, and now we're seeing that decline. I'm not even showing the 20-period moving averages, the simple or exponential right now, because we're below them. There's another chart where I have it with the other ones. Now, this support level is holding up for right now. This is anchored weighted moving averages. Even though we're declining, we're still above this orange line here. That's another layer of support that we'll be watching. And then looking at the short-term rainbow, I usually only show this in the deep dive video over the weekend, but we've come through this, but we've come through it pretty quick. Now, the longer we stay below this, the more the lines are going to start to roll over. And so we just want to keep an eye on that. You can see when we were really going up, this was nice and smooth for the most part and going up. And even when we came back down in it, we didn't stay here for very long, and that kept the lines going back up. Now the lines are starting to flatten out a little bit because we've been down below the 20-period moving average for a number of days. And we're into the -2 channel with the Keltner, or excuse me, with the standard deviations chart. These are Keltner bands here. And now we switch to the intermediate term. We are more negative with the balance of power. We're below zero and declining. And we're starting to get extreme here with the Connors RSI. Now we see really spastic moves here on a day in and day out basis, but it tends to not become extreme negative or positive all that often. And we're right about at that point currently. Turning more negative with a brown bar here with the go no go system. And we're hitting the lower band here with the lowest low value. That's more negative. We're still positive with the proper order. It's still registering an uptrend. Hasn't switched yet. But now we're turning even more negative with the TTM squeeze. We're starting to drop below zero. And that really didn't turn positive. It started to roll over the first part of November and never did come back positive, even when we were trying to go back up. And we're below zero and declining with the ease of movement. That's negative. And the Arun just kind of, it was just flatlining there for a while. And now it's coming down just a little bit. It's still leaning more positive. And then the S&P McClellan oscillator below zero and declining. That's negative. So we're going down with the summation index based on price and volume. That's negative. We're below zero and declining with the NYSE McClellan oscillator. So we're going down with the summation index based on price and volume for the NYSE. And we're negative with the Swindler Trading Oscillator, and we're dropping below the midpoint. Now, this had held up and was actually looking positive, and then late last week it started to roll over and look more negative, and it's continuing to look negative right now based on price and volume. Momentum is negative. The PMO is declining. We're dropping a little bit below the moving average based on price. We're dropping a little bit more below the moving average here based on volume. So we're seeing some weakness with the PMOs in the S&P that are rising. The buy signals are below 50 and declining, and we're starting to roll over. This was actually holding up until late last week, and now after Monday, it's seeing more weakness. The PMOs inside the S&P that are above zero, that's now starting to turn down. And we're negative with the Elder's Impulse system for the S&P. We never did turn positive with the parabolic SAR. And we're negative with our oscillators. The slope oscillator below the moving average and declining. MACD below the moving average and declining. So in the two short term, they're confirming each other now. They're negative. The three intermediate term are also negative, and the long term oscillators, they never really did turn positive, and now they're just switching back and looking more negative. And the Copic curve, another momentum oscillator, is negative. We're seeing more of a decline with the Sean trend meter. We're below 50 and declining with the money flow. We're still above 50, not really showing too much here with the ultimate oscillator. We are declining with on-balance volume, but we're still above the advancing moving average. And the bullish percent index for the S&P declining here. It was quite negative after Friday, and it's even more negative after Monday. These are the point and figure sell signals that are now being generated inside of the S&P. And we're also below 50 and declining with the NYC bullish percent index. And we're below 50 and declining with the NASDAQ 100 bullish percent index. And the RSI, intermediate and short term, we're dropping further below 50. That is short and intermediate term negative. And we're seeing a little bit of a rollover now with the intermediate term trend based on 50 periods. The red line and the blue line are starting to come down. We've spent a number of days below those lines and we're getting far away from them, so they can't help but start to decline. And we're now dealing with the 50 period moving averages. We held on to it after Friday, but now we lost that after Monday. And then the intermediate term rainbow, we're coming in here, but see, the lines are still pretty smooth for right now, even though we're inside of the rainbow. Now, if we stay here for a while, or if we drop down further into the rainbow, or even drop below it, those lines are going to start to get a little messed up. But for right now, they're still looking fairly smooth. And then we want to keep an eye on the 100 period moving average, just in case we start dropping below this S1 pivot point here and start heading towards the 100-day moving averages. That's the next level that I start to watch. And now here's all of these. With the 20 period, we're below that. We're below the 50 now, but we're still below the 100 and 200 moving averages. And then we're coming into the top end of the rainbow with our Ichimoku cloud, and we're dropping below all the lines. The green line here, that's more short term. The blue line, that's intermediate term. That's starting to come down to the red line, which is more long term, and prices below all of these. So we'll be watching to see if it finds some support at either where it's at right now or somewhere in the cloud. And we're still looking okay here, but we see, I've been trying to point out that we still see the integrity here, higher highs and higher lows for the most part. We haven't damaged that too much, at least yet. Now, if we continue to come down, that's going to make things look a little bit different. But still, these bars are looking okay for right now. And then we're looking more negative with the hike in ASHI. We're negative with the KEGI, negative with the Renko chart, negative with the three line break. So all of our different ways that we look at the trend, they are negative right now. Long term, seeing a bit of a hit coming down to the midpoint with the 150. We're still above the midpoint here with the 200 moving average. And here's the long-term rainbow. We're just coming into the high end of that, and the lines are still going up for right now. We'll be watching this. If we come down a little bit more and these lines start to roll over a little bit, that will show us that things might be turning more negative for longer. All right, so we're negative across the board in the short term with all the different stock indexes that we follow, and we're negative in the intermediate term with the mid caps. Now, I also have us negative in the intermediate term with the S&P. It's just a little bit different way that I do things. And we're negative with stocks. Bonds are still negative in the short term. Commodities are positive across the board, and we're still seeing a bit of strength here in the short and intermediate term with the dollar. And then we saw utilities. That was the one area that was up. Everything else, even healthcare, was down a little bit. But see, the financials just getting hammered again here. But energy ended up getting hit. Tech was down. Discretionary was down, not quite as much. Communication held up a little bit better here. So this was a lot of the growth areas actually holding up better than some of the other areas. But all the sectors ended up being negative except for utilities by the time of the close. A lot of red here. Then we saw a little bit of a bounce after the market opened, but we had the BPI cross and the communications below 30. Now that could be becoming oversold when we get below 30. That's when we start to look at it in a contrarian manner. And then we had the NASDAQ going below 22.9. Then somehow it got above 23,000, then back below 22.9, then 22.8, 22.7, 22.6. And then we had a BPI cross above 50 with the NYSE. That's broader, but then we ended up losing that later in the day. The Dow, which just set an all-time high less than a week ago, now it's going below 47,000. And then the S&P below 6,700. Canada also having kind of a rough day. Eh? All right, so we're down just a little bit below the 50-day moving average with the Dow. Now, I don't follow this one as close because it's only 30 stocks, but a lot of people do. But the fact that we're below this, yeah, that's a little bit more negative now that even the Dow is seeing more intermediate term weakness, even though it's still in a longer term uptrend. And we're negative with the diamonds. With the Elder's Impulse system, we're below the 50-day moving average. We're holding at this S1 support level. We'll see if that ends up mattering for the NASDAQ. We're negative with the Elder's Impulse system. Holding above this S1 support level with the NASDAQ 100, but now below the 50-day moving average. Negative with the Elder's Impulse system. Momentum, negative for the NASDAQ 100 below the 20 and 50 period moving averages for the QQQs, which is the ETF for the NASDAQ 100. And just coming down, but we're still holding at this S1 level for the S&P 600 small cap index, but we really saw a decline below its 50-day moving average, and we're falling further below the 50-day moving average with the Russell 2000 small caps. And you can see we're starting to get extreme here with the RSI, but the momentum continues to be negative. Negative with the Elders Impulse system for the small caps. Mid caps actually dropping below this S1 support level. And the mid caps have been the worst performing index, even when we were going up. They were still pretty much in last place. They just haven't done all that much. They came up with everything else last spring, but then they've just kind of gone flat ever since then. And they're negative with the Elders Impulse system. Now, the Wilshire, which held on to the 50-day moving average, it lost that on Monday. A broad market measure, as did the total U.S. stock ETF. We're now below the 50-day moving average. Financial sector getting hit hard here, down 1.91%, still holding out above its 200-day moving average. So we're keeping an eye on that. We've been watching this going back to last spring. This underperformance of the financial sector to the S&P, that just is continuing. And now to get a little different perspective, I look at the ARC ratio to the S&P. This is ARC FinTech, another financial ETF. We're falling further below the 200-day moving average, and this is a little bit above the 200-day moving average with the ETF itself. Then the bank ETF falling underneath its 200-day moving average. It had been just kind of going along below its 50, but above its 200. Now we're seeing some more weakness here. And FANG, it held out right at its 50-day moving average after Friday. Now it's below it. A little bit more weakness there. So Amazon coming down and testing its 50-day moving average. Apple was down, but it's still looking okay in the bigger picture. Microsoft down a little over 0.5% below its 50-day moving average. Google still looking okay here. It was up 3.11%. It was kind of the black sheep of the market there. And then here's Meta down below its 200-day moving average and still declining. Nvidia, which will report after Wednesday, still dealing with its 50-day moving average. And then Tesla, it got up. It was up a little bit here, up over 1%, but not quite back to its 50-day moving average. Netflix, which continues to be weak here. It was one of the better looking charts there for quite some time. That seems to be a bit in doubt right now. And then the semiconductors, this is still positive. We're still just a little bit above the 50-day moving average with the Dow Jones Semiconductor Index. That is one 50-period moving average that was not lost on Monday. And then we're still just a little bit above it with the SMH semiconductor ETF. So we haven't lost all the support. We want to watch the semiconductors and see what happens, especially with Nvidia getting ready to report. And then here, this is the distance from its 200-day moving average. Now, this is a weekly chart, and we were getting up close to that 100% above it, believe it or not. And now we're starting to come down. And when we see really extreme readings like this, that's quite often when we see more of a decline. Now, they're getting hit. Semis are getting hit with everything else, but we're not really seeing a general shift yet. We want to watch those 50-day moving averages that I just pointed out. And then here, the Dow Jones Semiconductors, they're coming down, but they're still over this 100% level above the 200-day moving average. So we'll be keeping an eye on this. And sometimes when we get to this level, that produces more of a significant decline. And the semis to tech ratio, bigger picture looking okay. Now we're seeing some weakness currently when we look at the semis to tech and see what's holding up better. And the Bitcoin. Now, the only reason I'm showing this is because it's having an impact on the NASDAQ 100. We've switched over. I'm not much of a Bitcoin person, but I do follow it over the weekend when the market's closed and so forth. We're seeing a downtrend here, and we're really seeing a big downward move right now with Bitcoin. What I'm looking at this for this video is that we see a pretty high correlation between Bitcoin in red, which has been declining, and the NASDAQ 100, which also is under some pressure now. And you can see when we get a high reading like we're having right now, they're going in the same direction at the same time. And right now that is down. And then we look at the staples to tech ratio. That's actually going up as the market's getting more defensive. But the bigger picture, this ratio still is continuing to go down. And we want to look at some of these other ratios here. Discretionary to staples coming down with the weighted version and equal weighted version, declining with tech to utilities, actually coming up a little bit with biotech to healthcare, but we're rolling over with hotels to utilities here. So we're seeing some general weakness in the market as we're rolling over and coming down a bit with the semiconductors, home builders, transports are starting to drop off here. Retail is seeing some weakness, and the regional banks are showing some weakness as well. And then oil still hanging out around the 59 level. Really didn't change all that much on Friday. Now, here's an interesting chart. This is a daily chart of the dollar. And notice we're still in a downtrend. We have a ways to go before we see a golden cross with this chart. All right, and we're still below the 100 level. And we really haven't been doing all that much with the dollar. It goes up a little, goes down a little, goes up a little, down a little. But what's interesting is now here's the weekly chart. We're starting to see a golden cross here because these moving averages weren't as far apart from each other. And so it's kind of the opposite of what you would think. And I pointed this out over the weekend. You would think that the short term, the daily chart would turn positive and then the weekly chart would follow. We're seeing just the opposite of that right now, where this is starting to show more of an uptrend. And the dollar going up could pressure stocks. The market likes a weaker dollar for conversion rates and import-export relationships there. All right, and then looking at bonds, doing okay here. We are above 4% with the 10-year yield, but not really causing any problems for the market right now. And we're just a little bit above the 50-day moving average with the 10-year based on price. And we're just seeing pretty much weakness here with the Qs to S&P. It did tick up a little bit, but we're below the declining moving average. Discretionary to S&P, that's trailing off. We're still below a declining moving average when we compare large cap growth to value. So the large caps are below the moving average, mid cap showing a lot of weakness. We did bounce up with the small caps, but we're still below the moving average. And we're going back up here. But the bigger picture is that we've been declining when we look at the staples to S&P ratio. So yeah, we're seeing shorter term weakness. The bigger picture still hasn't changed yet. All right, and then the great Hindenburg omen here. We don't have a new spike, but we have seen a series of spikes. And I got to tell you, I ignored this for years because I first heard about it from a perma bear, and I tend to fade whatever they say or do. If they're negative on the market, I'm positive. If they're positive on the market, which is rare, then I tend to turn more negative. And one of the people that I follow, I just look at their basic email. I don't subscribe to them or anything. But they're like, it's Hindenburg Omen. It's only right 20, 25% of the time. And I'm like, okay, then I need to pay attention to this. If they're blowing off one of their favorite all-time indicators because they're always negative on things, maybe I should put a little bit more into this. And then Stock Charts came up with this chart where they have the criteria that you see back here, one, two, and three. Well, they put it all on the chart for you, so you don't have to crunch all the numbers yourself and come to whatever conclusion that you want. But we don't have a new spike here, but we had the initial spike back in October, and now a number of spikes after that. And to give it some historical context, we saw that right before the COVID crash, and we saw it at the end of 2021, and we went into 2022. And this has now been confirmed, and we'll just it's negative. And so there's nothing's ever a done deal here. But we need to respect this and pay attention to it. And we're starting to see a bit of that play into the market right now. All right, so the outlook, just I've said this 4 times now with Nvidia reporting their earnings, and we are now, okay, I should have changed that. We're now negative in the short and intermediate term. We're still positive in the long term. I have no idea what economic reports will be coming out. I haven't even tried to figure those out. And then anything geopolitical, it's more what's happening um, just within the US economy right now and worried about these economic reports. So I haven't updated this. Then seasonality. When we look at November 18th, going back to 2002, we're neutral to positive with the Dow and S&P, or we are positive with the Nasdaq. Now we're coming into options expiration week now. And so this tends to be up more than down. So we do have some historical positive statistics there. And then I swapped this out here a little bit, but this is just the calendar where we see some positive seasonality, then goes down a little bit over the next couple of days before we see this. I follow the green dash line here, and it shows us where options expiration is coming up. And then we have Thanksgiving later in the week or in the month. Okay, and then this is the positive seasonality that seems like a lot of folks were pretty much taking that for granted. Where November tends to be one of the stronger times of the whole year. Yeah, tell that to the first half of November. This also shows positive seasonality going into the end of the year. After the Fed comes out and does what they're going to do, we see sideways action here, and then typically positive seasonality after that. And then this also shows positive seasonality. Tell that to the first half of November, as we see with this chart as well. And then this also shows that November tends to be stronger. Now we're only halfway through it, roughly. And so, things could turn around. We could get that Christmas cheer thing going and see some prices actually start to go up. And then this is showing December. Just I have it here just so we have this chart up and ready to go once we get into December. All right, and then the warning signs, we're looking negative with all three of our smart money indicators. Shorter term, we're negative with the growth to value and discretionary to staples ratios. The Swindon trading oscillator is negative, as is the parabolic SAR. Money flow, momentum oscillators are negative, and we're negative with the S&P and NYC McClellan oscillator and summation index, ease of movement, and all the bullish percent indexes are negative. And the vortex is negative, as is the momentum for the NASDAQ 100. And I just went through the Hindenburg Omen, which is now confirmed. And then on the positive side, longer term, we're still hanging on to uptrends with growth to value and discretionary to staples. The ultimate oscillator, it's still holding out for some reason above 50. And the financial sector is positive, even though we got hit hard on Monday, but it's continuing to underperform the S&P. And then over the weekend, I have a daily and weekly special K chart that is still positive there. And I wanted to show this. I also post this on the YouTube community tab, where we're still holding out above this pivot point right here on the daily chart. And this is a number of different ways that they are calculated that some of you might find helpful. And these are the pivot points. I rely on these very heavily. These are the pivot points for Tuesday's session. All right, so our conclusion, we are negative in the short and intermediate term. We're still positive in the long term. We're below the 20 period moving average. We're seeing negative momentum building in the short term, and we're starting to see a trend, which is now negative. And that same thing, although we're below the 50-day moving average in the intermediate term, but now the trend is starting to develop where we continue to be positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.